Hi, everyone. For those who are already joining us, thank you guys so much for signing up for Financial Life on the Farm, or if you're a young alum or an alum or staff or after the farm, now that we're integrating both life on the farm and after the farm. So give us a couple minutes. We're gonna get started 2 minutes after 5 to give everyone a chance to join us. And thank you again for attending. Alrighty, thank you everyone again for joining us today for our Fundamentals of Investing webinar. We're just going to get started in just a couple minutes just to give others a chance to join us. So thank you for joining early. Alrighty, so thank you everyone for joining us today. My name is Juan Vargas with Stanford Federal Credit Union, and we're definitely appreciative of everyone in our community joining for these financial literacy presentations, a series of part of Financial Life on the Farm and now after the farm. Today we're going to have fundamentals of investing, and we're also going to go ahead and introduce you to Mind Over Money. Miss Angela Amarillas will go ahead and give you a little bit of information about herself and the program, and then we'll go ahead and go into the presentation. And Angela, go ahead and take it away.
Welcome, everyone. We're really excited to be bringing you this really great content today. Mind Over Money is the financial wellness program designed for you. Assuming that you are a Stanford student of any kind, a postdoc at Stanford, or a young alumni. We aim to equip you with the knowledge and skills to make informed financial decisions. Also, we aim to democratize access to that information and all of our resources, and to cultivate a campus culture of healthy financial behaviors and conversations. You can find more information and resources to get engaged with your financial wellness on our website, which is mindovermoney.stanford.edu. And I want to point out that on that website, you can also request a session with a financial coach for free. So you go to the financial coaching tab and you'll see a bunch of smiling faces, including, by the way, Juan Vargas and Chris Lee, who are both on this call with us today, because they are both financial coaches with our program. Chris Lee is going to take it from here, and he's a lot more than just a Mind Over Money financial coach. And I will let him introduce himself and get us going.
So hi, everyone. My name is Chris Lee. I'm currently a DCI fellow at Stanford, but I was also a Stanford alumni. I was back in business school back in the late 80s, early 90s. And great to be back and have a chance to share with you my experience. I've been spending my career in the investment field for 28 years. So I'm happy, looking forward to share some of the foundation of investment with all of you today. So let me try to share my screen. So can everybody see the screen? Should be okay, right? Angela, see it, right? Okay, perfect. Today, I'm going to cover quite a broad variety of topics, and from what is investing, from saving to all the different asset classes and the risk reward, the myth and common mistake in investing, and talking about probably the most important part of investing is a portfolio construction and your asset allocation policy, and then how to set goal, have a plan, and execute a plan. But before I get into the detail, I'd like to get a survey, a polling question for the audience so that I have a feel sort of the level of knowledge in investment from the audience. Where I like the interaction part. So if Angela can help me to put the polling question, and if it's a simple one, I'd like to see where the audience are in terms of these three questions. All right, so let me just take a quick look on here.
We're still getting responses. It looks like we're at 75% participation. Okay.
All right, I think
I'll end it all in the poll for us and let you look at the results.
Okay, so a quick sort of a survey of the result. Majority of us are not related, don't have a major economic, financial, business. 89% of us are all others. And how many of us know your net worth? I think 1/3 don't know what net worth is. 70% know what it is, but no time to calculate. About half of us know it, which is not bad. And then, do we have asset allocation policy? 30% that have it, 70% don't have it. Okay, good information. Thank you for doing that. So let's talk about what's investing. I contra investment with like speculation, and there's no textbook definition to differentiate the two, but there are a few characteristics that I can touch on. First, I think they're both great investor and great speculator. So I'm not particularly saying that, well, people should not speculate, but you just have to know what you're doing. The differentiation between two tend to be in time horizon. Speculation tend to be short-term horizon, want to make money tomorrow or next hour. Investment tend to take a longer-term horizon. I want to make money and be rich over the long term. Speculators tend to like to take higher risk because that's how you can generate higher return or losses, but that's how they want to do it. The decision criteria is also different. Speculation tend to focus on market sentiment, momentum of the market, what hearsays are, and investment tend to do more fundamental research and understand what the valuation of the things they're buying. The investor attitude is the biggest difference. Speculators tend to care about what something worth eventually. What they care about is provided I can sell it at a profit. Investors want to own something that would eventually worth more than they buy. So speculation have a higher leverage. They use leverage to get a higher return and volatility. And investment tend to have low or moderate type of leverage. We talk about foundation of investing. The most important, just like building a house, you want to have strong foundation. The most important part about foundation of investing is savings. Because if you don't have money, then you can't invest. And the second principle is understanding the long-term power of compounding. Einstein reported said that compounding interest or growth is the eighth wonder of the world. It's really powerful. And he who understands the power of compounding will earn the compound return. And he who doesn't will actually pay the compounding interest to other people. So the question for you is that, do you want the money to work for you, like you earn the compounding return, or you have to pay somebody else the compounding return? Whether you are working for the money you own. So you definitely want to be an investor and not a debtor. The next slide just show a little bit the effect of compounding. How to be a millionaire. There is a simple way to become a millionaire. You save $33 a day and you do it persistently. And assuming you earn a decent return of 6% over 30 years, you have $1 million. Now, this table have two observations. First is, well, return matters, because if you think about 6% versus a 10% return, you have to have over 30 years, you have more than double your money. But the time horizon is also as important. If you save your money 10 years earlier than your friend, look at the 25 year and the 30 year. Well, you start 10 years earlier, you have more than double your money. So saving earlier and invest earlier is one of the sure things you can build your wealth. How much should people save? So I have young kids as well. Two of them just start working and they'll ask, Daddy, how much should I save? So I say, well, 15 to 20%. And my daughter say, that much? That's like way too much, right? No, it really depends. It will give you a lot of flexibility down the road. And 15, 20% is a lot more rule of thumb for just one goal, which is your retirement. There are multiple goals in your life, and I'll touch on that later on. The second question, I think, with the alumni, young alumni and students, is that when you have a job, make sure you max out your 401k matching. I spent 20 years on helping people manage their retirement asset, and I was amazed that a lot of people leave money on the table. They don't max out their 401k matching. Well, I hope that Stanford students are smarter than that. If a company match you 50% or 100%, that means that you immediately have 50% or 100% return on the money you put in 401k. Where else do you get that return? And why won't you take maximum advantage of that? So make sure, number one thing, whatever company match you, you max out those matching. The next question I normally have is whether I should put in Roth 401k or normal 401k or Roth IRA. There's definitely a tax question on that. Because any Roth saving, you don't tax, you pay after tax. So that don't get the tax saving upfront, but you get it down on the future. But think about the chart I show you that, right? So particular for early start in your career, your tax bracket may not be the maximum yet. So you put a lot of money in the Roth. As you're making more money, your tax bracket become higher tax, then you may want to consider then putting like on a pre-tax basis, okay? It's a tax question, we don't really know, but depending on your outlook on what tax bracket you will be in. And I'll touch on a lot of asset class because investment actually is fun. There's a lot of things you can invest. So it's really exciting. People tend to get too overexcited about it. Now, it's like a buffet menu I'm going to touch on today. There's a lot of food on the table, but doesn't mean that you have to eat all of them. So I'm not saying that you should invest in all of this, right? But rather you'll be probably overfed, okay? But I want to touch on all the things so that you know it's an exciting market. You have a lot of things you can do. So there are stocks, which most people talk about. And within stock, even there are different types of ways to invest in stock. Large cap, small cap, US, international, emerging market. And there are bonds, which few people actually like to talk about it. I started my life as the fixed income manager. And I remember I was in the Rockefeller Center in New York, and the other table of rich like people talk to see that we're talking about investment. They come over and talking, what do you guys do? They, well, we manage fixed income. What is that? People tend not to like buy bonds. They tend to talk about equity, but there are roles in bonds. They give you income, and there are different kinds of bonds from the safe one, government, corporate, municipal, mortgages, and there are real estate. Also, a significant part of a lot of people's investment portfolio, particularly out here in Silicon Valley, your home price is really high, and your home could become one of your largest assets. So it is part of your portfolio. But there are other things as well besides your home. There are commercial, industrial, retail type of investor or risks that you can invest in. And then if that's not enough, there's alternatives. Fancy name is other things than stock and bond and cash. There's the alternative. There are people who group that into it, like private equity, venture capital, very popular in this Silicon Valley. There are hedge funds, there are private credits. And then there are commodities. Again, few people talk about that, but most recently it's more hot topic because actually, if you may know that both stocks and bonds are down this year, but commodities are actually up this year. So they provide some diversification, particularly in inflation time. And then there are currency. So some people don't think currencies is a investable asset, but they are actually is. So besides US dollar, the Euro currency, the pound, the yen, the Chinese currency, and they are crypto. They call it a currency, and it's also debatable, are they real currency or not? But crypto obviously is a recently hot topic. I show this colorful chart, and there's a lot of fine print inside the little boxes there. Now, the purpose of this is not for you to see the fine print on the boxes. The purpose is for you to see the diversification and the randomness of those colors. There are a lot of asset class, but one thing you observe is that the winner of one year may not be the winner next year. And so there are benefits of having different asset class in your portfolio. That's called diversification. You can reduce your volatility. Let's talk about equity investment. You can look at equity investment in different lenses. There's public and private. Within public, that you can trade on exchange, like individual stock, exchange trade funds, mutual funds, index fund, and then there are the fancy thing like options and futures. They're also exchange traded, so that's in a public market. And there's style, they're active and passive. And then their market cap, the mega cap, like the FANG stock, there's a really, really big $1 trillion market cap, to all the way spectrum to like micro cap, which could be only like $100 million in market capitalization. You can look at also from a geographical lens, the US international emerging market, and you can look at the valuation. So earnings and dividend are more tangible. You can read it, it's published, you know that. And they don't change that much. Think about it, right? You know the earning report once every quarter, and dividend doesn't even change once a quarter. They may change once a year or once every few years. But then the stock price moves all the time. So why does stock price move all the time when the earning and dividend doesn't change? Well, that is what I call the valuation change, right? The PE expansion or contraction. And valuation tend to be like more sentimental. sometimes it's quite a lot of imagination in it, what we expect, what we think it would worth. And they tend to be changing all the time because people change their mind all the time. So understanding this is important. Because most of the volatility of stocks are actually driven by valuation change, i.e. by the sentiment and the expectation, rather than the actual earning and dividends. Normally, I get 4 questions from my friends when on equity is, should I buy individual stocks or funds? If I buy funds, should I be active funds or passive funds? And if I really want to buy stock, how much should I diversify? And then, should I really own foreign stock? Do I need to? Or is it just own US stocks? So that tend to be the 4 questions I encounter. I'm definitely happy to answer questions later on if there are further questions than that, but I'll touch on these 4 things really quickly. First, individual stocks versus funds. Let's talk about funds. You buy a fund, you pay management fees on the fund. That's what the equity manager do. They charge you a fee. Secondly, you don't have control over the turnover of the fund. So sometimes you have to pay capital gain tax, even if the fund doesn't make any money, because they actually realize gain and you have to pay for it. The next thing is that individual stocks tend to be more volatile than funds. You can lose all the money in a single stock, but not likely on a diversified fund. On the flip side, great wealth building is on fewer stocks rather than too many stocks. If you look at the really rich people, they tend to build their wealth on, single company that they found. And even you look at the big investor like Warren Buffett, he doesn't own a lot of stock. And so don't buy too many stocks if you really decided to do stocks. But you really have to ask yourself, do you have the time and skill to find good individual stock? Hearsay is not a good strategy. Just hearing what other people say is not a good strategy. How about funds? They have active funds versus passive funds. Now, active funds charge fees, and some of the funds have very high fees. Some of the funds even charge you 3 to 5% to get into the funds. So you think about it, they have to be really good to worth you pay so much for them to outperform the market. Because you started in the hole already by paying the fees, so they have to earn more than the fees to sort of make you even. The sad thing about that, actually, most active funds do not outperform their respective benchmark. I think last year, majority, depending which number you wanted, 80% of funds did not outperform the benchmark. And it's not particular one year, it's a consistent sort of situation. The active manager do not, because, well, they'll pay fees first. And passive fund, now they have very low fees. You can buy S&P index fund for 1, 2, 3 basis points. It's almost nothing. But you would not outperform, you underperform by the tiny fees you pay. Active manager is really good, particularly for those consistent outperformance. Again, you have to have the skill and time to find good active manager. And passive index fund is not totally passive, which is actually the good news. Passive index fund follow a benchmark. The benchmark actually are regularly managed. Some stocks get kicked out from the index. Some new business, new fund will get into the index. So just be aware of that. So passive fund is not totally passive either. If you insist that, Chris, I want to pick active fund, so I would suggest 5 P's for you to think about. First, people. Who manage your money? Who are the manager? Are they qualified? Right? Who are they? Philosophy. What does the fund buy? Is it a value fund, a growth fund? Is it a core fund? Or what do they buy? What's the investment philosophy? What's the process? How do they buy? Turnover. Is it 20% turnover or 200% turnover? Remember, the higher turnover, the more capital gains you have to pay. Is it a team decision or individual decision? Is it a quantitative or qualitative process? Price. What's the annual fees? What's the low fees? For what price are you paying for that? And then performance. Performance is actually very tricky. You need consistent performance. And consistent performance means that it's like a 5 years, 10-year type of performance. There's a book called Fooled by Randomness that say that, well, if you don't even have 10-year performance, you don't really know what's random and what's true skill. And the worst thing you can do, which unfortunately most people do, and I actually, when I was young, I did that as well. So how do I pick funds? I look at last year performance, which fund did the best, so I go to buy it. Don't do that. Please don't do that. Because you should do that. Well, how do I pick fund? Look at the last year performance. But because there's a strong mean reverting. So last year best fund tend not to be the next year best fund. It tend actually to be the next year worst fund. So be careful about that. Now, if you still don't listen to my advice, I really want to pick stocks, which is fine. I know people like to do that. Then don't pick too many. Because first, you don't have time to do too many. Actually, 30, 40 stocks is plenty. Okay, because only too many, it's just you become an index fund, so you may as well just buy index fund. Okay, so at the end of the day, ask yourself, do I really have time to pick individual stock? Do I really have an edge? I.e., I have superior information and skill to pick individual stocks. I just look at statistics. Most of us didn't major in economic, finance, or business. So my question is to focus in your career. You'll probably make more money by focusing on your career and spending much time trying to pick individual stocks or funds. Now, the next question is actually an interesting one because most people, well, I know probably young people don't pay much attention to foreign stock because US has outperformed the international market in the last probably 20, 30 years, actually. So there are some beneficial factors to own foreign stocks. You supposed to provide diversification, but having said that, with the globalization, the US company, particularly S&P 500 company, actually have a global presence. So they actually have the diversification already. And 40–50% of the revenue actually come from overseas. So you already diversify into the international market. So make sure you understand the underlying driver when you go into the international market. Emerging markets have changed quite a bit. The old day emerging market are resources-rich company in Latin America or Africa, and now it's actually the Asian focus, like emerging market that overweighted in technology, actually. So we understand when you go again, understand why and what you are buying. The US actually used to be about 50% of the MSCI all country index, now like 61, because US has been outperforming. Think about it, US has been the still most innovative country in the world. So not surprising they have been taking advantage of the technology and did well in the last few decades. But having said that, just give you a history. It's not always the case. You see, when this line goes down, means US underperform. When the line go up, means US outperform. And you, as I say that, well, since 2008, US done really well. But even you can go back since 1990, US had done well on this run. But before that, it's not the case. Actually, foreign stock outperform US. We're just probably too young to remember to know that. Now, I like this chart because I always emphasize long-term investing. This is a really long-term chart, 1871 to now. And it's also an inflation-adjusted return, which is even better because you can look at true, real return of equity. As I said, the trend is up. It's a very nice upward channel. But I want to also say that, well, in the short term or even medium term, sometimes stock didn't do that well. And that's why sometimes we need diversification. And we are also on the upper channel, i.e. that, well, I mean, because we've done so well in the last 10 years. It's actually one of the longest bull market we have. So just knowing that, okay. And stock have three components, as I mentioned that, so I want to repeat that, but make sure that it actually only go up in the long term. And this is a good chart as well. In the short-term horizon, it can be anything. stock can be up 30% or down 37%. It happened, okay? But notice that if you have a 20-year horizon, the range of return are much more narrow. And they're all positive, actually, on this period, at least. Actually, even go back for a period, it's the same. It's if you have 20-year horizon, equity tend to be like positive return. And so in a sense, if you're 20-year horizon, it really doesn't matter when you buy it. If you're a 1-year horizon, yeah, no matter when you buy at the peak, the next year you're down 30%. Okay. Next, I want to talk about the current market about bonds. I think you are all young. I'm probably the oldest one here. You're so young that you don't even remember high interest rate environment. You're so young that interest rates are always low, but it wasn't the case before. This is a 30-year bond yield, and it could be as high as 15% before. 15. I mean, it's almost like alien to you guys, because, well, 15, I can imagine that, right? We tend to get to 2, 3, 4%. And the longer term perspective is that, think about that, right? Even interest rate went up quite a bit today, where all the news went interest rate went up a lot already. But from this perspective, we are still in the very low end of the interest rate history. Two things, remember, bonds is not intuitive, even when I taught my son about fixed income. First, interest rate and bond price are inversely related, i.e. interest rate go up. If you buy bond price go down. And there are two components of return on bonds. One is a coupon you're receiving every quarter or every 6 months. The other is a principal you get back in maturity. Only in maturity you get a principal back. If you sell your bond before maturity, you can actually have losses or gain. So it's not as fixed income as people think it is. It's only fixed if you hold to maturity, and only if it doesn't default. So a little bit misnomer about the fixed income part. And corporate bond and mortgages would normally offer high yield. Why do they offer high yield in government? Because they are a little bit more risky. So they are potentially may not give you a principal back. Next, I want to touch on is, so if bond is so low in yield, 2.5% for 30 years, why do I want bond in my portfolio, right? Is again, this is a chart between S&P 500 and bond with a ratio. You see, there are times that actually bond outperform stock, believe it or not, right? If you have buy bond in 2000, you actually outperform stock for quite a bit of time. If you buy bond in 2007, with a stock, you actually outperform. So there are times that it's good to have bond in a portfolio to have a diversification effect. And you've seen that, well, actually stock has outperformed bond for quite a bit already. You look at historical chart, and you wonder, okay, is this what's going to happen next? The next, I think, elephant in the room this year is inflation. Now, inflation is important to understand. Inflation reduces your real return. Inflation will drive high interest rate that affect both equity and bonds negatively, both. And that's why this year both stock and bonds are both down, because interest rate went up. And inflation also reduces the real spending power, because if you have paid a lot of money on get gas pump or food, you have less money to consume elsewhere, right? So that could actually cause a recession. And I like about this chart actually from one of the Fed, St. Louis Fed, or Chicago Fed. It's the 1950s to now, and you can see currently inflation actually spiking quite high. The headline inflation is 7.5%. Even you strip out energy prices and food prices, it's running at 6%. We haven't seen this high inflation since the 1990s, actually, 20-some years ago. So that's high. That's why it's the talk of the town right now about inflation. And the other observation, again, is an observation. It's not a prediction, but I just want to point out that you see all this gray bar on this chart, and all this gray bar are actually recession in the US. And majority of these gray bar are actually preceded by a jump in inflation. Like you can see that, right? So this is an interesting observation, and that's why it became a talk of time. Ooh, is inflation going too high? What will happen next? So that's why the Fed really don't want inflation to keep going high. They want inflation to come back down. Next, I want to talk about the myth and common mistake. This is, I think, believe it, this is important because I see too many myths and too many mistakes that people make. And I make a certain fair share of it when I was young. So hopefully that we talk about this. The first mistake, people buy high, sell low, and then people will laugh at me. Chris, who would do that? I mean, it's buy high, sell low. I mean, but actually a lot of people do that. So why? Because we're driven by emotion bias. When things go higher, our greed come in. We want to chase the market, we buy high. And then when the market starts going low with fear, I'm worried about losing more money, so I need to get out. And so I basically buy high, sell low. I remember that when I worked in a hedge fund, and my boss, who is obviously a very successful investor, and they said that, well, unfortunately, human psychology are not made to be a good trader. We're made to be a terrible trader because of that fear and greed. So avoid it. Secondly is people believe in the bias sample in cocktail parties. In cocktail party, your friend will tell you, I buy the XYZ stock or this XYZ crypto or whatever went up a lot. And in social media as well. But remember that this is a bias sample. People only brag about their winners. They never talk about their losers. So all you hear is a bias sample, how much money people make, and they know that a lot of people go broke as well, but you just never hear about it. So remember that, right? So they will make you think twice. Third, about human behavior is that there are no patience. We want to make money tomorrow. Who doesn't? I remember my boss in hedge fund, I make a trade and then I lose money. I thought the market's down and then tomorrow, and I was upset, and my boss comes and said, hey, Chris, when you make an investment, you don't expect to make money tomorrow. So that's a lesson I learned. Be patient, right? And bit of noise in the short term. So Paul Samuelson said that investing is more like watching paint dry or watching grass grow, right? You're patient. You don't want to go out and pull the grass up. You're going to kill it, right? You're patient, let it grow, right? That's why I showed you the long-term compounding effect. Let it grow, okay? If you really want excitement, take your money to go to Las Vegas. It's not too far away from here. But we have to differentiate that psychology, right? And most investors turn the winner game into the loser game. This is an amazing number, and ours, I don't believe it myself. Look at this. Somebody did a study, JP Morgan did a study on the 20-year horizon, and look at the average investor, how much it makes, 2.8%. I said, that's bad. Because all other indexes are more than 2.8%. You have to do things consistently bad to get that kind of return. And there are two reasons for that. One is all the mistakes that people make, right? They make mistake, buy high, sell low, you get low return. But secondly, if you are into a lot of active fund, you pay a lot of fees. I mean, if the fund charges 1%, 2% upfront, you lose the 1-2%, right? So avoid those mistakes and minimize the fees you're paying, then you will improve your performance dramatically. So how do I avoid it? Our psychology. Beware of the madness of the crowd and the bubbles. People lose the most money when they chase bubble and buy it at the really, really high. And this FOMO is a wonderful term. Fear of missing out is so ingrained in our psychology, right? And how to avoid it? I give my friends advice. Wow, geez, somebody buy this thing up so much already. I'm missing out. And I said, yeah, you have missed out already. You have missed out already. Chasing it now it's going to be the worst mistake you can make. And the behavioral finance, we are all full of behavioral problems. So there's probably in the last 20 years, a study said, well, because a lot of finance assuming that the human being are rational decision maker, and all the study later on show that we are not rational making anymore. We are all kind of biases, recency effect anchoring. The stock was 400 and now it's 200, must be cheap. Well, a lot of things have changed, right? The anchoring back in 400 is not the right thing to do because maybe the new competitor come up, right? And so the company no longer viable. So it used to worth 400 doesn't mean they will worth 400 again. Loss aversion, we tend to, a pain of losing money is 3 times more than the pleasure of making money. And we end up is we kill a winner too early, and then we let our loss run along. So that's why I avoid trading, because we are not made to do trading. Overconfidence is, I see it all the time, and even including myself, right? Particularly now we have 100% for students, we have, gee, of course I'm good, right? Of course I can pick stock, of course I can beat the market. Well, I'm smart, right? Well, I always say that, well, if that's so easy, then why is there so few successful investors? Right? It's hard, right? And then, but we don't have time to do it. So don't be overconfident, okay? And know what you own and know what you're investing in. Well, really important. Know what you own and know what you invest in. If you don't, it's just based on FOMO or hearsay, just be very careful. We talk about greed and panic, and so that's why I write them out. So Charlie Munger, Warren Buffett's right-hand man, they say, focus on long term, write out of up and down. Many times that people panic and ask me what to do. My 401k just dropped 20%. I say, do you need the money tomorrow? No, I'll do nothing, right? Don't want to do nothing. That's just how you write it out, right? Otherwise, you end up selling the low. Sizing matter. Think about it in terms of percentage portfolio. So that's why I always ask you to think about the asset allocation policy, the percentage that matter. Because some of the cocktail party that people track about, oh, I buy this stock that they double, right? Okay, how much net worth you put in, like 0.5%. Okay, you're 0.5% in that stock and double, you make 0.5%. Great, but doesn't really move the needle, right? So the percentage is what will matter, right? And last advice is that being too conservative could become risky, particularly in the inflation environment. Cash is safe in the short term, but it could be the worst asset to beat inflation in the long term. Think about today, your cash yield is 0.5%, inflation running 6-7%. So it is a challenge, right? It's not going to beat inflation. Now, despite I show you that inflation chart does scare you, but timing the market is really hard. It's a chart that at first I even question, is it right? I mean, even I look at that. It's a 20-year return on this, 2001 to 2020. And basically say that if you take out the best 10 days, you miss out the best 10-day return, your total return cut in half. Can it be true? It is true for 2 reasons. First, those 10 days market went up a lot, the 3 to 5% type. And because you miss out the 3 to 5% compounding over a long term, it actually takes down the return a lot. And you miss out the 30 days return, your negative return, almost shocking. So unless you think you are really, really, really good, I can time the market really well, stay in the market, because if you miss those days, it's going to subtract a return a lot. And the other reason why people sort of end up missing a lot of return is that 7 of this best 10-day return after 10 worst day. So what do you mean by that? Those worst day people panic, sell out, and they forget to get back in, and they miss it, right? And people also have a hard time saying, I just sell it. I don't want to buy back next day, but the next day started going higher, so they miss it. So it's a really hard game to play in terms of timing the market. So try to avoid. And the other foundation about investing is about setting goals. Have a plan and execute your plan. Goal without a plan is just a dream. Your goal will never be reached. A plan without execution is just hallucination. I have a plan, but never do it. It's just, well, you're in hallucination. Now, how do we set goals? Now, you have multiple goals. You should have multiple goals. From a long-term goal about your retirement to a medium to long-term goal, sending kids to college, to buying a house. So you have different type of goals. And one thing is true is having different goals will allow you to set different investment target for each goal. It's important because they require different investment allocation. There's a use of online tools. There are a lot of online tools, apps that will help you to plan and set different goals and then have different allocation for you to achieve those goals. But general rule of thumb is that the longer term the goal is, the more aggressive investment you can, because your time is in your favor. The shorter term goals, you need to be more conservative. If you need your money tomorrow, it should be all in cash because you should not, the stock could be up or down tomorrow, right? So, but if you think for retirement, don't worry about the up and down market. You can take a lot more sort of equity investment. Setting goals have a lot of factors. Some of them you can control, some of them you cannot. As I was taking a class at Stanford right now, I said, well, don't worry about things that you cannot control, which is true. Things you cannot control, you can't worry about. You can't control anyway, like gravity. Or in the engineering class, they say, well, you can control gravity. You don't worry, you can solve it, just deal with it. So the market volatility, you have to deal with it, right? And change in taxation, things like that, you just have to deal with it. You can't really control it. The thing you can control marginally, longevity. Well, we all want longer, but you live a healthy style, you have longer longevity. But that means that you also need more saving for your retirement. And your employment, you have some of those as well in terms of control. And the most control you have is your asset allocation policy and your spending and saving behavior. Asset allocation policy is probably most important decision you should have in your plan and your goal. And if you don't have it, don't forget about picking stock and picking fund. Those are just icing on the cake. You need to have a cake first. So you need to focus on asset allocation policy. Set one, okay? And then the different factor go into the investment policy. Different one is different. So that's why I talk to an investment advisor. Do some simulation in your planning tool. And basically, that's why I told my kids, right? When they start up, Daddy, what's my allocation policy? I think, well, mostly in equity, like 90% plus in equity. And they say, wow, what if the market go down next year? Well, you're saving every year, right? The market go up, go down next year, your money to buy it cheaper. So why not? Right? So don't worry about it. Right? Keep buying every year, it will come back up. And you can deal with it now, but you need the money next year, that's a different story, right? So you're saving for retirement, a lot of equity. Rule of thumb, it's not just a rule of thumb, right? When I have the allocation is that 100 minus your age also. So if you are 20 years old, you should have at least 80% equity. If you are 80 years old, then you may want to have 80% in like capital preservation asset, right? So that's the rule of thumb. It's just a rule of thumb, not a silver bullet. The long-term horizon, the more growth asset you should have. Understand your own risk tolerance is very important. People panic because they don't understand their risk tolerance, right? A lot of people think, then people tend to take more risk in good time because they, oh, I can do 20% down, but when down 20%, they panic, right? So understanding your risk tolerance is important. So like understanding your risk tolerance, set asset allocation policy, and stick with it. Building a portfolio, that's why there's a lot of, I talk a lot about the buffet menu, the other thing you do, but you don't have to do all the things. Basic thing is that set your asset allocation policy, use index fund to achieve that policy, right? And then you're 80% there already, right? That's the most important message I hope you can take out from that. Remember, if you don't have an investment account, set up one, and then you decide whether you want to do it yourself or get an investment advisor. Doing it yourself is not that hard. Well, determine your asset allocation policy, stick with the low-cost index fund, okay? And then remember, it's an auto-pay policy. Well, if you save it every month and put money in every time, rebalance periodically. That's important. Rebalancing is where you can buy low, sell high. Okay, that's how you can help you to buy low, sell high. What means that? So the thing about it, you have policy 80-20 and the equity market go down, and then you become 70-30. You buy more equity, going back to 80, sell more bond, sell some bond. And vice versa true. 80% is 90, you can sell equity back to 80, and then so you are actually consistently buying low and selling high. So rebalancing policy, but you don't have to do it too often. Once a year is good enough. With that, I don't want to remember, set a goal, have a plan, and go execution. And I want to pause here and know there's a question, and feel free, then I would try to answer the question as best I can.
Yeah, great. Thank you so much, Chris. So if you stop sharing, I'll share the slide. This is very, very exciting as we segue into the question and answer time. I want everyone to know that we, in honor of Financial Literacy Month, which is the month of April, the Stanford Federal Credit Union is going to raffle off 3 $50 Amazon gift cards. The way that you enter the raffle is to fill out that quick survey that you see on your screen, either by typing in that URL or use the QR code. The way that it'll work is after we're done here tonight, and by the way, this is only for those of you who are listening in on this Friday evening, not on the recording. So those of you who are here live, you are eligible for this raffle. So when we're done, I will run a random number generator and pick our 3 winners, and Juan will be sending you your gift cards. So I'll let Chris take the Q&As. Are you able to see the chat and the Q&A?
Yes, I'm able to see it. So let me answer the simple question first on the chat. A book recommended to read, I think Angela also have recommended one already, and I would recommend another one, which is very easy to read. It's called The Little Book of Common Sense Investing by John Bogle. I think it covers a lot of things I talk about, and it's a really easy book to read. So I would highly recommend that book called The Little Book of Common Sense Investing. So it's little, so very easy to read. The second question about is what's the 80-20 rule? So basically the thing is that the 80-20 rule is that you can achieve 80% of goal with almost 20% of the effort. And the last 20% of the goal, you have a lot more effort to get to. So basically saying that, well, you take it simple, right? So set an asset allocation policy, buy low cost index fund, will achieve 80% of the goal or investment return already. A lot of other things I talk about, picking stock, picking active funds, or getting into like other alternatives would help you, but it's really icing on the cake, the last 20%. The last 20% take a lot more effort to get to. So that's what I mean by the 80-20% rule. Okay. All right. So a question about targeted fund. I always choose the targeted fund. And for the year that I turned 65, is that a mistake? what should I do instead? Okay, so I would say that it's not a mistake. The reason that people promote targeted fund is that, well, if you are 25 years old and then you tend to retire at 65, for example, then you have 40-year horizon. The targeted fund will already give you the asset allocation that is mostly in equity. And then as you close to retirement age of 65, they will slowly drive down the risk asset and give you more capital preservation asset as you close to retirement. So in a sense that it is not, because targeted fund will automatically have the building mechanism in terms of, I say that the longer term horizon, you have more equity, and the shorter term horizon, you have more capital preservation asset. So the targeted fund, if they do it right, is supposed to do that already. I think people sometimes also look at targeted fund and say, wow, gee, S&P up 20%, why my targeted fund up 16 only, or even 14, 12 only? It makes sense. It's not 100% equity, but that's the beauty of it. On the other hand, if today, this year the market be down 10%, your target fund could only be down 3, 4 only, and not 10. So that is a diversified portfolio, which is fine for most people. Again, but bear in mind, that is only for your retirement goal. You have other goals as well. So I would say that that's not a mistake. Anchoring came up in behavioral psychology section as well. What's anchoring? So anchoring is that we tend to our mind would get anchored a lot. Just think about going to bargaining. So you go to the market and ask you how much it's worth. A good salesperson would be like, maybe $10, will he say 100? Then you say, well, so you anchor by 100 already, you try to negotiate down to maybe like 50, and you feel good about it because it's not 100, it's 50, but the thing may be only worth 10. So this is part of the example of an anchoring effect. So people will try to give you a buyer thing to anchor it. And there's a lot of tricks in the market. People do that. They'll do a private transaction at a high price, assuming, oh, that was the price that is out there, but you think that there's a true price. So this is what I call anchoring effect. Can you give a quick explanation of basic pros and cons of trading futures? Oh, wow. This is a whole class on this, but so first, you know what futures is. Futures is basically you buy something that settle in a future day. It's a derivative. The future, the price is based on something like the underlying. So that's why it's not it's called derivative. So S&P futures are futures, but you're not buying the whole S&P today. You're buying settle on a future day, and there's some massive price between futures and the spot. Pros and cons. Pros is that you don't have to put down your leverage. You put down a margin on it. But there's pros. You don't have all the money to do it. You can still own a lot more things than you would own without that like margin, without the whole coming up all the money. So it's just a pros. It's also a cons because that's why people lose all the money. So if you get a margin call, then you lose everything. If you own the underlying, the S&P may go down, but you never lose everything. So I think that would be the cons.
Great. I think those are the questions that came in the Q&A box. We have technically 2 minutes left. So if somebody has a very quick question, we will let you answer it or let you ask it. So I'll pause. And I will mention that we had a little bit of a midway technical difficulty, so it's going to take us a little bit to stitch the 2 recordings together, just so you know. But if you were registered for this webinar, Juan will send you a link with some follow-up information, and so you can review this information on your own later. So
one last question that came in just recently, if I can answer. So what's the cost ratio is considered low? As I mentioned, index fund today is very cheap. If S&P index fund is 1 basis point to 3 basis points, really, those are low. Some would be 5 and 10. You think, why do I need pay 5 and 10 if I can pay 1 or 3, right? So that's one perspective. Active fund tend to charge you maybe 1% on average, right? Then it really depends how good they are, right? If they charge you 1% and they give you only like 1% type extra return, then you say, do I really want to get a bet to put 1 in and make 1 back? So that's not particularly good, like cost reward ratio, right? If you say they charge 1%, they outperform like 5% over like 10-year time per year. Well, that may be worth it, right? You put 1% to 5. But I tell you that the extremely few fund who can do extra 5% versus the index. Extremely few, particularly over a long-term horizon. So get back to you, ask yourself that if I give them that fees, what reward do I get back? So they calculate that cost ratio.
That's really good advising. Thank you, Chris. So we've come up to the end of the hour. Thank you very much, all of you who are still with us, and those of you who are watching this video at a later date. I commend you for wanting to know more about how to be financially well now and into your future. Thank you all. Thank you, Chris.
Bye, everyone.